Hi everyone, Andre here from SeeWhy Learning. As I'm sure you're aware, Canada is feeling the health and economic ramifications caused by the coronavirus. Yesterday, the federal government announced it will be unleashing $27 billion in direct aid, as well as a further $55 billion in tax deferral to help businesses stay afloat. It seems these days, unless you're manufacturing toilet paper, there aren't too many safe places to hide, and most of us are a little worried about our budgets. Fortunately, at the urging of the federal government, most banks are offering the opportunity to defer mortgage payments for up to 6 months. So if you're worried about being able to make your mortgage payment, help may be available. Now I know in terms of economic uncertainty, it's easy to grab that lifeline without understanding or even asking about the details. To be clear, I think it's a great program that will help a lot of people, but I need to stress that deferral is not interest-free. It does come at a cost. What each bank is offering will vary, but this is what my mortgage lender is offering. Let's assume the outstanding mortgage is $500,000 and the monthly mortgage payment breaks down as follows. Principal portion, $1,100. Interest portion, $1,266. Property taxes, $400, for a total of $2,766. Paying $2,700 could be difficult if the borrower has seen their income substantially decline. Here's how one bank is helping. The borrower is allowed to defer their payment for up to 6 months. Some banks may offer less. During the deferral period, the borrower is only required to pay the property tax portion of $400, a cash flow savings of $2,366. The borrower does not have to make principal or interest payments. Now be careful, that does not mean it's interest-free. The interest will accrue and will be added to the mortgage balance. When payments do recommence, the mortgage payment will be adjusted upwards, but only marginally. For example, let's assume a total of about $7,600 of interest accrues over the deferral period. The principal owed would then become $507,600, which then has to be paid off over the remaining amortization period. The skipped interest payments are just added to the balance, and the repayment period remains the same, albeit with a slightly higher payment. The increased payment, though, may not be that substantial. For example, an additional $7,600 financed at a rate of 3%, amortized over 25 years, would only increase the payment by about $35 per month. Of course, over the span of 25 years, with compound interest, the actual cost is greater, but it's better than defaulting on your mortgage. Also keep in mind that with most mortgages, there are opportunities to make up extra payments without penalty down the road when things get back to normal. Therefore, before you grab that lifeline, be sure to ask the right questions and understand what you're agreeing to.